Welcome back. I definitely owe you some videos. I appreciate everybody who stayed subscribed or all the new subscribers because the channel actually hit 2,000 subscribers even though I have not been posting in a while. That's what inspired me to get back into the habit of posting, so I'm hoping to get a few videos out there in the near future and maybe get into a regular cadence. I'm going to try to do a lot more of the individual stocks because that's what people like to see. It also takes the most amount of work, but I think it's the most informative. I'm going to start with ones on my watch list that I'm considering buying, and then we'll go from there, okay? So first one up is CROX. Now this might sound crazy. The first time it was suggested to me, I just brushed it off. I think I saw it on the Magic Formula, and I said, okay, nobody wears Crocs anymore. That's a dead company, right? This is crazy. So that was it. I forgot about it. And then my dad actually came back from a visit with my brother, and he told me, he said, man, you need to look into this company, Hey Dude, and see if Hey Dude is a public company. He said that they went to some store, it was completely packed, that a bunch of the young guys were all wearing them, and you know, whenever you see the product, I completely agree. So I looked into them, turns out they were bought by Crocs. So what is Hey Dude? Hey Dude is a shoe retailer that specializes in their own words, light and comfortable shoes. So their big seller is going to be the Wally and Wendy. Let's see, for men it's the Wally, for women it's the Wendy, but I'll show you. It just looks like kind of like a topsider, Sperry's topsider shoe. I can tell you, in high school we were forced to wear dress shoes every day with khakis, and I know that if this was an option, every single person in my high school would have been wearing stuff like that, like these, right? Something comfortable, slip on, and stylish. I don't have a pair. That's an ugly one right there. Look at that. Let's see if we can find the LSU one. That's another thing. I saw, okay, let's go to collegiate collection. I was just at an LSU game the other day, and this just came out. So, oh, there it is. All right. So these just came out, and I saw a commercial for them. It was during the Ole Miss game, so that was probably, a month ago, 3 weeks ago? Like 2 weeks later, all of a sudden, the campus is just filled with people wearing these. And I checked back the other day, and they were just sold out completely. So sold out that it wasn't even listed on the website, but today it's listed, so that's good. Anyway, look at these beautiful shoes, huh? So if you don't think that this is going to be popular with every college, at least in the South, and probably the frats everywhere, then I disagree, right? I think it's going to be a hit. Anyway, that's not what we base all of our stock analysis on, right? I'm not going to say, whoa, their shoes are great, let's go buy them. Okay, we're going to look at the financials, the underlying financials, and go from there, right? Okay, so let's get started. Okay, so we're going to go back to the old way that I did valuations because I think this is so important. I think people overestimate their ability to detect patterns, to read charts and tables whenever they're just looking at raw data. Like if I show you this, this is okay, here's the date, revenue. You're not going to, there's no way that you can look at this and grasp any sort of pattern, okay, unless you're a robot, right? One of the best things our species ever did was create the graph, right? It's one of the best human inventions. Charlie Munger talks about it because it helps us simulate motion, which is something we're really good at. Think about how good we are at throwing a rock at a moving target, a moving rabbit or something. I don't know, whatever we evolved to do. We're not sitting there calculating the vector that the rabbit's running at and then how much force we need to throw the rock at and then using, 1/2 AT squared, all of that. That would be how an AI does it, right? We just do it. It's very intuitive. And that might be a bad example, but it shows that we're very good at detecting visual patterns, not necessarily through raw numbers. So anyway, that's why I prefer to look at data visually. I'm also an engineer, so that's part of the reason why I think I'm obsessed with the graphs and visuals instead of just numbers. But anyway, that's my preference, and it's done pretty well for me. So look at this revenue graph. This is crazy, okay? This is where they bought Hey Dude late 2021. Maybe it closed early 2022, but I mean, this is an exponential for sure, right? So revenue's growing at a ridiculous rate. Let's see, is the gross margin translating? So there's gross profit. Yeah, it's going up exponentially too. So one thing that I think is a great rule of thumb, quick valuation of a company. Remember, this is every quarter, so these are quarterly numbers. Don't think that this is the yearly number. But I think it's actually a great idea to look at pre-tax income, estimate what you think it's going to be in, let's say, 3 years, and then just multiply that number by 10. And that is a very crude, rough, fair value for a stock. So you want to be conservative, right? You don't want to come up here and say, oh man, look at this growth. It's just going to continue growing. I mean, unless you have reason to believe so, but high growth rate will get you in a lot of trouble in valuations. Okay, so if you did this and you predicted, oh man, we're going to be at $400 million per quarter in pre-tax income, that equates to a $16 billion market cap. It's selling for $5 right now. Back up the truck, right? I mean, it's not out the realm of possibility, but I don't think that it's wise to assume that, right? I think something better might be just assume that it's probably going to stay in this range-ish. So let's just say 200. I know that it's obviously in between 200 and 250, but one thing I'm terrified of in investing is making too optimistic of assumptions. I want to try to be realistic if possible. And to be honest, with all the stuff going on in the world right now, and inflation and recession fears, it'll probably go down significantly because it's a luxury good, and then probably wind up back there once things even out. But we're not worried at all about short-term impacts, right? The only thing good about short-term effects is that it might let you buy the stock at a cheaper price. Okay, so let's just say 200 million per quarter. So 200 times 4 is 800. Oh yeah, I'm getting good at that. So anyway, multiply that by 10. Remember, this is a million, so this is technically 8 billion. And then yesterday market cap closed about 5.32. So I divide, this is just a ratio, right? So I divide by the market cap. Oh man, I forget. Okay. So it's about 1.5 times is what our target is over the 5.3 billion. And then I multiply by the share price that it closed at. So fair value, remember, this is a very rough estimate, $130 a share. We'll see how close the DCF gets to that. Okay, that's enough the income statement. We're going to go to the balance sheet. So balance sheet is super important. Look at this asset jump. This is whenever they bought Hey Dude, obviously. Okay, so current assets. I want to know, are these assets just goodwill? Which, it's not a bad thing, but you also don't want to account for them. And I'm sure it is, yeah. So goodwill, they had almost no goodwill. Then whenever they bought out Hey Dude, now they have $2.5 billion of total assets. So their tangible assets is closer to 2 right here. All right, so with tangible assets about 2 billion, their total liabilities are about 4. So you're looking at a negative tangible book value, and I could just show you that. Negative tangible book value. This is, like I said, it's your tangible assets minus your liabilities. Now the good news is that since that huge dip, they're obviously paying down all the debt that they used to buy it. I assume that's what's going on. So let's see. Liabilities. Well, let's just look at total debt. Total debt. Yeah. So they were at about $1 billion of debt, went into $3 billion of debt to buy Hey Dude, and they're dropping that. They're at about 2.25 now. It's important that the debt's on the way down, right? If you're looking at a company and the debt looks like this, like it was back in this period over here, that's a little bit of a red flag that, your debt's just rising. It doesn't mean stay away completely, but you need to know what the heck's going on, that sort of thing. All right. I want to look at inventory. I think inventory is very important for any retail company. So basically current assets, under current assets, inventory. And you want to make sure that finished goods inventory isn't rising, really. So we'll look at finished goods. Remember this, okay, they just don't count it like that. This is just an error in the software. So we'll just take total inventory and assume, finished goods proportional with this. So I'm not worried about this big jump. This is just the acquisition. Inventory is working down, which is fine. Down or steady is good. Even a controlled up is okay. as long as that's, part of their growth. Like if the company's growing and so they're growing their inventory slightly to account for their larger footprint or something like that, that's okay. What you don't want to see is stagnant growth and then inventories rising a lot, because that means nobody's buying it, right? Okay. That's the balance sheet. Oh, we're going to go cash flow statement. All right. Cash flow statement, 3 parts, right? Operating cash flow, how much cash is the operating business bringing in? Then it is investing cash flow. Investing cash flow is going to be how much cash are you investing back into the business or buying other businesses, that sort of thing. So obviously the Hey Dude acquisition is going to skew this scale. I'm just going to remove it for scaling purposes. So investing cash flow is negative because it's money leaving the business. Okay, operating is going to be positive. Investing cash flow is usually negative unless they sold an asset, in which case it would be positive. But I mean, look at this, 25 million a quarter. That's nothing, right? That's small peas. So what was the operating cash flow? Operating cash flow roughly 300, probably 200 million. Yeah. So yeah, the investing cash flow is very small compared to the operating cash flow. That's important to keep in mind because CapEx goes under investing cash flow, and you want to be mindful of companies that spend a lot of money on CapEx, because it could look like they're making a lot of operating cash flow, but it's all going out the door in CapEx every year. Okay, and then lastly, financing cash flow. What are they doing with the cash that's left over or not left over, right? If they're losing money, then the financing cash flow is going to have to be positive to make up for it. If they're making money, it's got to be going somewhere, right? So the financing cash flow is if they're doing things like paying down debt or paying dividends or buying stocks back. Okay, stock back, however you say it. Okay. Once again, they took out a big positive $2 billion to finance that purchase. If I take that out, now the scaling, look at this. This is a beautiful picture for financing cash flow. As an investor, you really want to see negative financing cash flow because it means, like I said, that the money is being spent to really drive value for you. Anything that's negative in the financing cash flow is going to be value towards the shareholder, right? It's either paying down debt, which is good for the whole company, including you, or it's paying dividends to the shareholder, or it's buying back shares, which is increasing your stake in the business. Obviously, you can nitpick if they're doing the exact right thing with the money within the financing cash flow, but in general, it's good. So where is most of that going? So if I financing cash flow, let's see, is it payment of debt? Yep, that's a lot of it. See, $250 million a quarter in debt repayment most recently, so that's really good. And then let's see, are they buying back shares? I wouldn't expect them to start buying back until they really get that debt where they want it to be. All right. So what all this leads to, though, is free cash flow. So free cash flow is going to be your operating cash flow minus your CapEx. So pretty much how much money is the business bringing in, and then how much CapEx do you have to put back into the business to keep it going. So this is the graph of free cash flow every quarter. Cash flow really jumps around a lot, so I like to look at it on a trailing 12 months basis. So basically it just sums the previous 4 quarters. So if I do that, and it smooths out the curve too. Look at this. This is ridiculous. This is awesome. So where do we think we're going to be? That is the $1 million question, right? Because the stock price is going to go with the free cash flow. So if you know what the free cash flow is going to be, you know what the stock price is going to be. Average here of these last 4 has been, what is that? About $550 million a year. That seems reasonable. Let's say that they come back down to earth, 500 million per year, and then we got to figure out a growth rate. So obviously I'm not going to assume this crazy growth rate. I mean, look at what they've done just in a year. You're talking close to 100%. Okay, so you can't assume that. So just in general, like I said, the stock price will be proportional to the free cash flow in the future. So let's just say the price P in the future is going to be equal to the free cash flow, the existing free cash flow times 1 plus your growth rate raised to, however many years, times some multiple, right? So let's just say some multiple M. All right, that took forever. But anyway, what I'm trying to show you here is that G, growth, is the only thing in this equation that's raised to an exponent. So overestimating growth is deadly. It will make you think that you found the cheapest thing ever. Watch what happens if you go slap a 15% growth rate on something for 10 years or something like that. All right, it'll be, just don't worry about that. But even, whatever PE you assume, technically this isn't PE, this is price per free cash flow. It doesn't matter what you start with. I need to put a 0 here. It's the initial free cash flow. But these are way less important than that growth rate, right? So the best thing to do, assume a low growth rate and then be pleasantly surprised if it's higher. Okay, so with that in mind, let's go to the discounted cash flow model. Okay, so like I've told y'all before, I will send you the DCF page for free. Just email me. My email, I think it's in the description or on the channel somewhere. I'll send this to you. The other stuff is way too buggy and requires, I can't send that. But I'll send you the DCF page here. This is a standalone. Okay, so basically what it does is it takes some inputs for, what do you think the cash flow is going to be the next 3 years? And then you put a growth rate, a discount rate, and then it calculates terminal value. All right, so we said that cash flow was going to be $500 million. So let's say they have a terrible year. Let's say we go into recession. They barely make any money. Well, shoot, they make 0, break even, because nobody's buying shoes and, people are starving. But let's just paint that picture. And then we come back up to, let's say 300, and then we have another time at, then we climb up to 450, okay, and then we go from there. All right, and from that point, the growth rate is going to be 8%, and my discount rate, I'm going to use 15%. Okay, so that gives me a terminal value of roughly $4.8 billion moving forward. Okay, so I started with a pretty stark example, right? So the market cap right now is 5.3, so it's saying, okay, look, your net present value's not quite there, But keep in mind, I used a terrible assumptions, not terrible, but, let's say pessimistic assumptions. I used a really high discount rate, and the growth rate is much lower than what they've been demonstrating, right? So now let's go back and let's just put in what they've been doing. I want to show you how crazy things can change. So I said 550, right? So if it's 550 and they're growing, let's say at 10% instead, now, we're at double digits, I bet. Yeah. Terminal value, $11 billion versus 5.3. So let's say 10.9. 10.9 divided by 5.3, almost double. Yeah, I didn't need the calculator to do that. It's double what the current price is. Okay, so there's a huge wide range of value here, and that's, I know that this isn't helping you if you were just hoping to click on a video and say, tell me what stock to buy, but I think the process is what's important to learn. So personally, I have this on my watch list. I'm waiting, and maybe I'm stupid for waiting, but I'm waiting probably for $75, $70, maybe even $70. I think it's probably a good price here, but I still like to wait for a better one, especially with other stocks being down, right? Because I'm comparing them to my opportunity cost. But that's just my take. Like I said, I'll send you this sheet to play around with. I'll be putting some more videos out there. I appreciate everybody watching. Please comment, subscribe, comment especially. Comments really help the channel, and it gives me ideas for new videos. Thanks again. I'll see you next time.